$300,000 in income, $180,000 in taxes. Your 37% federal bracket is a lie. Most high earners believe the US federal income tax rate topped out at 37% is lower than Germany's or France's, so they assume they're paying less overall. Research shows you're paying more, and that misconception could cost you six figures over a decade. By the end of this video, you'll understand why a household earning $400,000 in California faces a 48% effective tax rate, matching or exceeding what the same household pays in Berlin or Paris. You'll see the three hidden tax layers Americans forget to count. You'll discover the fourth layer most people miss entirely. And you'll know whether your next career move should be an international relocation or a shift in US tax strategy. Let's start with the core mistake. Your federal income tax bracket tells one story. It's not the whole story. When you earn $300,000 in a high-tax U.S. state, you're paying 37% federal income tax on income over $231,250. That's roughly $25,000 just on that top slice. Then 3% self-employment tax or split employee-employer FICA of 65% each, another $22,950 in combined contributions. Then state income tax. In California, that's 3% on your top earners, another $39,900. Add local taxes, property tax equivalents, and you're looking at $180,000, $200,000 in total tax on $300,000 income. That's 67% nominal burden. But wait, the IRS allows deductions. Realistic effective rate after standard and itemized deductions, 52%, still staggering. Now compare Germany. Top marginal income tax, 42% federal plus 5% solidarity surcharge, that's 5% on the highest earners. Add 7% combined employee-employer social contributions, that's another $56,100. Add VAT at 19% on consumption. A euros 300,000 earner, roughly $325,000, pays roughly euros 135,000, euros 155,000 in total taxes, an effective rate of 47%, not cheaper, but notice the structure. France is similar, maybe slightly worse on paper. Top rate, 45% income tax plus 2% employee social contributions, plus 42% employer contributions on payroll. VAT, 20%. A euros 300,000 earner faces euros 135,000, euros 160,000 in tax, 48% effective. Same ballpark as California. Here's where the US narrative falls apart. Germany and France fund something the US doesn't at scale. Universal healthcare, subsidized childcare, and public pension systems are embedded in those social contributions. You're not losing that money, it's ring-fenced. In the US, you pay federal, state, and local income tax, then you buy private health insurance at $18,000, $25,000 per year. Fund your own $401k with after-tax dollars and pay property tax for schools. That's hidden tax layer number 3 that most earners never add up. The real delta. A household earning $400,000 in San Francisco pays roughly $180,000, $200,000 in federal plus state plus FICA plus local taxes. The same household in Munich or Lyon pays euros 170,000, euros 190,000, roughly $185,000, $206,000, but receives employer-subsidized healthcare, saving $10,000, $15,000 annually, and mandatory pension contributions, saving another $8,000, $12,000. After-tax purchasing power nearly identical, but the US earner believes they are paying less because they see 37%, not 42%. Here's the hidden layer number 4, consumption taxes. The US has no federal VAT, but California sales tax runs 375%. If you spend $100,000 post-tax income, that's another $7, $250, in tax that Americans often don't count in their total burden calculation. Germany and France include VAT in their quoted rates. So when you hear 19% or 20% VAT, that's already baked in. For high-income professionals in tech, finance, law, or medicine earning $200,000, $500,000, this gap reshapes decisions. Remote work now makes international relocation viable. A $500,000 a year consultant facing a 50% US effective rate might accept a euros 400,000 role in Berlin and net nearly the same after-tax income, while gaining 2 months of vacation, 3 years of parental leave, and subsidized childcare worth another $15,000, $20,000 annually. The proof is in the OECD tax database. Their 2022 analysis shows the US ranks 19th in total tax to GDP burden. But for high earners, those earning in the top 10%, the US effective rate rivals France, Germany, and Belgium once you include all layers: income, payroll, and consumption taxes. So what should you do? If you're earning $300,000, $500,000 in a high-tax state, stop comparing nominal bracket rates. Calculate your true effective rate. Add federal income tax plus FICA plus state income tax plus local taxes plus property tax plus sales tax equivalents plus private insurance premiums plus self-funded retirement contributions. Then compare it against a peer country's combined rate. The gap you find, if any, is your real decision threshold. Second, understand that US tax policy doesn't fund universal services. Your deductions and credits are the tool. Max your 401k, use HSAs, claim all eligible deductions. These levers are where high earners win. Numbers don't lie, listen to them.